Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Welcome to this week's Top Stock Picks of the Week. I'm Tracy Reinick, and I'm joined this week by Ben Rains. And we brought you a couple of Zacks #1 strong buys in completely different categories. One is in agriculture, the other is on the tech side. But some people have been calling the ag stock a tech stock too. Well, let's dive right in and see, because I'm the one who brought the agriculture stock this week. It is Deere, ticker DE. And I've talked about Deere several times in the top stock picks because I just can't stop looking at the charts and what its earnings are going to do. It's pretty spectacular. Let's dive right in and take a look. So what did I mean by spectacular? Well, let's just take a look at the revenue side. So this is this year's revenue growth, 27%. Next year expected to also see double digits, up another almost 13%. And obviously last year, a little bit of a lag because of the pandemic, but we are in the beginning stages of a new cycle on the agriculture side. It's entering into the beginning of its next super cycle. But remember, Deere also has regular construction equipment side as well. And we're all waiting to see if we're ever going to get an infrastructure bill that could really boost that side, which is already doing quite well as well. So you're going to have dual cycles going with Deere, both the ag side and on the just regular equipment construction side. So that's really why you're starting to see this big growth in the revenue side. But take a look at earnings. Again, last year was the muted pandemic year. Only saw $8.69 right there, but more than doubling this year to $18.90. And then look at next year, again, up another 17% to $22.19. So again, this is where we're really starting to see the impacts of entering into this new cycle. Now, what does it look like on the charts? This is the price and consensus chart. And you can see the prior couple of years, except in 2017, you can see we had the gains into 2018 there, as there was like a mini cycle there. And then everything kind of petered out and the stock just kind of kept treading water for several years, but now entering into this next new cycle. And nothing shows it better than what the earnings are expected to do over these next 2 years. You can really see the rebound. Some of it is from the pandemic, but a lot of it is simply just the entering into this next cycle. Shares also obviously rallying along with what's happening with the earnings, understandably so, and up 35% or so here in 2021. But over the last couple of months, shares haven't really done much. Over the last 3 months, up just 2 to 3% here. So kind of looking for another catalyst, or if it breaks down, could be a good buying opportunity. But what does that cycle actually look like over the longer haul? So this is the 20-year chart, and you might think, oh, look at that, it's crazy suddenly in 2020, and it's overvalued here. But again, with the E rising so dramatically, it's not that expensive of a stock. Deere's trading with a forward P of just 19. It has a PEG because of the growth side of the component of just 0.9. So none of that is screaming overvalued here, but we are getting a little bit, as I said, of a stall out in the shares. If we get a little bit more weakness here, I would be looking to be a buyer on any kind of that weakness. But as you can see in some of these other mini rallies here into 2008, there was a commodities rally into the Great Recession there. And so you saw the increase there. There's this mini rally here out of the recession. Then it was pretty many years of stagnance going on, but that's normal in the ag cycle. And then we did start to see the farmers buying again here in 2016 into 2017, a little bit of stack, and now it's taken off again. So Deere, great way to play agriculture, but also that infrastructure side. And again, if you see a little bit of weakness here, I would, have it on my watch list as a stock to dive in on any kind of pullback. So I'm going to throw it over to Ben now, where he's got the tech stock, and it's looking good as its Zacks number one rank as well.
Hello everyone, Ben Rains here. Today I'm taking a look at Roku, which trades in the ticker that's its name, ROKU. Roku traded at new highs at the end of July, but the streaming TV firm's stock fell heading into its second quarter release in early August, and then tumbled after its Q2 results on the back of what appear to be more near-term concerns. The company posted a sequential decline in streaming TV viewing hours and supply chain setbacks in its hardware business. But these make sense given the current global economic environment. Despite these worries, Roku's long-term bull case remains in place. Roku's small devices that plug into TVs and allow users to watch streaming TV content helped to become a mainstay in the industry. Roku's tech is also built into smart TVs, and it was the number one smart TV OS sold in the US last year, with nearly 40% market share. Yet its most important business these days is digital advertising, with its ad-focused platform revenue accounting for over 80% of second quarter sales. Roku makes money by selling ad space across its marketplace and taking a share of streaming service subscription revenue and ad inventory. Roku allows marketers to buy targeted ads, promote their streaming movies, shows, platforms, and much more. The category soared 120% in Q2, while its overall revenue climbed 81% to easily beat Zacks estimates. Roku's strong earnings revisions help it land a Zacks rank number one strong buy at the moment. And looking ahead, Zacks estimates call for Roku's 2021 revenue to surge 60% from $1.8 billion to $2.9 billion. Sales are then set to climb 38% or $1.1 billion higher in 2022. Plus, it is projected to swing from an adjusted loss of 14 cents per share last year to positive $1.30 per share this year, and then climb another 34% in 2022. Roku is currently spending to build out its own original content library and grow internationally, which could be key going forward. So in terms of the stock price, Roku shares have fallen roughly 28% since the end of July to push it below both its 50-day and 200-day moving averages. And the stock has been on a really wild ride this year, and its near-term downturn could certainly continue. The recent downturn has Roku sitting at oversold RSI levels of 30 at around 37. And the pullback has cooled its valuation a lot, with it trading about 45% below its year-long highs. Roku's current levels are rather enticing, especially since the NASDAQ and the S&P 500 are sitting right at records with stretch valuations. And the stock is still up 400% in the last 3 years. On top of that, Wall Street remains extremely bullish on Roku, with 16 out of the 18 brokerage recommendations that Zacks has coming in at strong buys. So overall, Roku is set to benefit from the expansion of the entire streaming TV industry, which includes the likes of Netflix, Apple, Disney, and countless others, setting up for years of growth as advertisers race to find consumers amid the cord-cutting revolution. And that does it for this episode of Top Stock Picks. Make sure to check out Zacks.com/promo for a look into some of our services, portfolios, and more.